All right, so you have a question, Picant, and this is from the Kaplan kit. And first of all, let's go to the requirement. The requirement is that prepare the consolidated statement of financial position of Picant. Okay. So this was your question. On 1st April 2003, Picant acquired 75% of the sender's equity shares. So now this percentage has been given to you, and there's no need to calculate that. So on 1st April 2003, Picant acquired 75% of the equity shares. In the share exchange of 3 shares in Picant for every 2 shares in Sender, that means you have to calculate the share exchange. Okay, in order to calculate the share exchange, first of all, you need to know the total shares of the subsidiary. And let's go back to the. So Sender is actually the subsidiary, and their share worth $1, and the total balance is 8,000. And that means shares are 8,000. So the total shares of the subsidiary are 8,000. And the parent has acquired 75% of the shares. 75% of the shares. And now you need to multiply it by the fraction. It gives you the number of shares acquired by the parent. Then you multiply it by the fraction that gives you the number of shares issued by the parent. So in a share exchange of 3 shares in Picant for every 2 shares. In the share exchange of 3 shares in Picant for every 2 shares, and so 3 by 2. The market prices of the Picant and Sender, now we have to take the market price of Picant, that is $3.20. Let me bring my calculator and then we can calculate it. All right, so now we have to calculate it finally. Okay, that's fine. We're gonna multiply 8,000 multiply by 0.75, okay, and multiply by 3, divide by 2, multiply by 3.2. That gives you 28,800. Okay, so now you can split it, because you know the double entry was debit cost of investment, credit share capital, and credit share premium. Fine. Okay, so you just do 8,000 into 0.75, multiply by 3, divide by 2, and multiply by $1, which is 9,000, and just replace the other figure, which was now multiply by 2.2. It gives you 19,800, and the total figure is 28,800. Fine. In addition to this, Picant agreed to pay a further amount on 1st April 2004. That means 1 year later. That was contingent upon the post-acquisition performance. That means it is contingent consideration. But you know the contingent consideration, we have to record it irrespective of the condition being met. At the date of acquisition, Picant assessed the fair value of the contingent consideration at 4.2 million. So at the date of acquisition, they were actually supposed to pay 4.2 million, but by 31st March 2004, it was clear that the amount to be paid would be 2.7 million. But at 31st March 2004, that means at the year end, they were expecting their liability to be 2.7 million. It was clear. They're not expecting, it was clear. So they were sure. Ignore discounting, fine. Picant has recorded the share exchange and provided for the initial estimate of 4.2 million for the contingent consideration. Fine, that means they're saying that Picant has recorded the share exchange. They have recorded this thing in the books and provided the initial estimate of 4.2 million. That means their liability is recorded at 4.2 million rather than 2.7 million. We have to change it. On 1st October 2003, Picant also acquired 40% of the equity shares of Adler, paying $4 in cash per acquired share and issuing at par 1 $107 loan note for every 50 shares acquired. So now this is associate because they have acquired 40% shares. Now let's go back to the statement of financial position. Here you see this is Adler, and the total shares of the Adler are 5,000. So 5,000 shares are the total shares, and they have acquired 40% of the shares. Okay, so 1st October, Picant also 40% of the equity shares at $4. So now we're going to calculate it. Is 5,000 into 0.4 into 4. It is 8,000. So the amount they paid in cash was 8,000. And the other one was issuing loan notes of $100, 7% loan note for every 50 shares acquired. So first of all, 5,000 shares are the total shares, 40% shares are acquired, and they have issued 50 shares, okay, for every $100 loan note. So, okay. Issuing at par $100 note for every 50 shares acquired. Okay, 50 for every 50 shares acquired. All right, so we have calculated the cash, 5,000 to 40% to $4 is 8,000, and then issuing at par $100 note for every 50 share. Okay, for every 50 shares, sorry, there will be a $100 loan note. So 50 is actually the denominator. Now we calculate the loan note figure. So it's 5,000 into 0.4 into 100 divided by 50. It gives you 4,000. So the total consideration paid is actually 12,000. Fine, that is good. Okay, this consideration has also been recorded by Picant. Okay, fine. Picant has no other investment. The summarized statement of financial position of three entities at 31st March are, okay, now they have the property, plant, equipment, they have investments, okay, they have the current assets, inventory, trade receivables, total assets, then they have the equity, okay, share premium, you see they have already recorded it, and retained earnings, okay, at acquisition at 1st April, then you have the for the year ended 7% loan note, you see the contingent consideration and the current liabilities. Now starting from the notes, the following information is relevant. At the date of acquisition, the fair value of the sender's property, plant, and equipment was equal to its carrying amount, with the exception of the sender's factory, which had a fair value of the $2 million above its carrying amount. Sender has not adjusted the carrying amount of the factory as a result of the fair value exercise. This requires additional annual depreciation of 1 lakh in the consolidated financial statements. So that means let's go to the workings, and you see, first of all, we know that how much percentage is acquired. Yeah, this one. Okay, let's go back to the balance sheet. We know how much percentage is acquired, 75%. Fine. So we can put here 75%. This is the working number one. Then you have the share capital of net assets of the subsidiary. So first of all, the share capital of the subsidiary, and let's go here. It's actually 8,000. So we'll be putting 8,000, and then we'll be putting, because that will remain same. Share premium, no, subsidiary does not have any share premium, nil. And then you have the retained earning at acquisition. Okay, at acquisition, first of all, you need to see the date. The date of acquisition was 1st April 2003, and yes, we have been given retained earning at 1st April 2003. It's 16,500. So we're gonna take it 16,500. And then we have the profit for the year. That means if we club these two things, it will give the retained earning at reporting date. So that will be 17,500. Fine. Then you have the fair value adjustment. Yes, they said, okay, that the fair value is 2,000 more than its carrying amount. So we'll be adding 2,000 here, and similarly 2,000 here. Then they said the extra depreciation is 1 lakh. It is already calculated, so there is no need to calculate that. So minus 100 from the reporting date. Fine, that's good. So adjustment number 1 is done. Okay, also at the date of acquisition, sender had an intangible asset. There's one more adjustment of 5 lakh for date of acquisition. For the software in the statement of financial position, Picant's director believe that the software have no recoverable value. So it was actually in the books, but it has no value now. So this should be written off. Believe that the software to have no recoverable value at the date of acquisition, and sender wrote it off shortly after its acquisition. Sender wrote it off after acquisition. That means it should not be represented the reporting date because it was written off, but at the acquisition it was still available in the books. So we will be only doing the adjustment of 500 at the date of acquisition, because you have to see this point that they have written that the Picant's director believed that the software had no recoverable value at the date of acquisition, and sender wrote it off. That means written off already after its acquisition. That means at acquisition it was present, so we just removed it from the acquisition. That is good. Fine. Okay, so this was intangible asset written off. Good. Okay, now let's go to the other questions. At 31st March 2004, Picant current account with sender was 3.4 million, which is the intragroup balances. This did not agree with the equivalent balance in the sender books due to some goods in transit of 1.8 million. If you remember the entry of the goods in transit, it was debit inventory, credit goods in transit payable with the with the amount of 1800. And then once it's recorded, it will be written off. So then debit payables, credit receivables by 3400. But had not received by sender until after the year end. Picant sold all these goods at cost plus 50%. That means there is the unrealized profit. Okay, so how are you going to calculate the unrealized profit? The price was 1800. Fine, this 1800. Picant sold all these goods at cost plus 50%. Okay, so this selling price represents 150%, and when you multiply it by 50%, it gives you, let me calculate on my calculator. So 1800 is the selling price because they have the markup cost plus 50%. So in the markup cost is 100%. Then you add the markup, it gives you selling price, which is 150. So this 1800 represents 150. And when you multiply it by 50, it gives you 600. So unrealized profit is 600, which has been sold by parent to subsidiary. So it will be deducted from working 5 and the group inventory. Okay, then you have Picant policies to value the non-controlling interest at the fair value the date of acquisition. For this purpose, sender's share price can be deemed. So now if you remember, the total share of the subsidiary are 8,000. We have acquired 75%, so that means 25% belongs to the NCI, and we have the share price of the subsidiary, which was $4.50. Okay, so we multiply it. We multiply it by $4.50. It gives you the fair value of the NCI. So 8,000 is the total number of shares. 25% belongs to NCI. So the number of shares belongs to NCI is 2,000. When you multiply it by 4.5, it gives you the worth of the NCI at acquisition is 9,000. Impairment test was carried out, which concluded that the value of the investment in Adril was not impaired, so associate has not been impaired. Due to poor trading performance, consolidated goodwill was impaired by 3.8 billion, so the impairment of goodwill was 3.8. Assume all profits accrue evenly through the year. So this is the question. Now let's come back. Now we're going to finish it. Okay, fine. So there are no adjustments in the working number 2. So we can total it. Okay. This is net assets at acquisition. This is net assets at reporting date. And the difference is, you know, the post acquisition. So this minus this is actually give you the 1400. Now the goodwill. Okay. And the goodwill we were actually, let's go back to the question. Yes. So on 1st April, Picant acquired 75%, and they were supposed to pay share exchange. The value of the share exchange was 28,800. We have already calculated that. Fine. And then you have the contingent consideration, which was 4,200. Fine. So it is 4,200. Then you have the value of the NCI, which we have calculated. And what was that? It was 9,000. Yes, here we have calculated that 9,000. So this 9,000, fine. Okay. And then you have the net assets at acquisition, which was 26,000. So what should be the goodwill on acquisition? We can net it off. It is 16,000. And what was the impairment? Impairment was 3.8 million. That is actually 3,800. And what it gives you? It gives you 12,100. So this balance should be recorded in the statement of sorry, financial position. Okay. And this balance should be shared between the parent and the NCI. Okay. This should be shared. What is the share? It's equal to 1,400. The parent's percentage is 75%, 0.75. It gives you 1,050, and the remaining is actually this minus this minus this, which gives you 350. Okay, so NCI value at acquisition was 9,000. Okay, NCI share is 350. We have calculated that. And the NCI share of impairment was, what was the impairment? 3,800. So first of all, we need to 3,800. 3,800 into 0.25. This is 950. Now we can net it off. So the NCI value is 8,400. So this should be recorded in the statement of financial position. Now let's come back to the parent retained earning. Okay. So let's go back to the balance sheet and the parent retained earning, where it is. Yeah. So we have 16,200 plus 11,000. So 16,200 plus 11,000. Because why we have added these two things? So this was at acquisition. This was the total year profit. When we add it, it gives you the retained earning at reporting date. Okay, the parent share was 1,050. We have calculated that 1,050. What was the parent share of impairment? So it was actually 3,800. 3,800 multiplied by 0.75. Okay, 2,850. Now we have to do the working of the associate as well. You need to show it. So associate. In the associate, there was a cash, which we have calculated, and there were loan notes. Okay. And now the second thing will be profit from associate. So this is the associate working, and yes, the cash balance. Let's go back to the question. We have calculated the cash. It was 8,000, loan notes 4,000. So yes, 8,000 and the loan notes were 4,000. Now you need to calculate the share of profit from associate. Okay, so let's go back here. The associate has the full year profit of 6,000 when the parent acquired it at 1st October 20x3. So October to March, October, November, December, January, February, March. So 6,000 into 6 by 12. 6 by 12, because October, November, December, January, February, March, 6 months. So 6,000 into 6 divided by 12. It gives you 3,000. So the figure from the associate should be, it's 15,000. Yeah, so we'll be taking associate profit here, which will be 3,000. Fine. And there's no unwinding, there's no acquisition cost. There is the unrealized profit, which we have calculated, which was 600. Yes. So we'll be deducting minus 600 over here. And there is one more thing, which was the gain on contingent consideration. We were supposed to pay 4,200 at the start in terms of contingent consideration, then it became 2,700. So the liability was actually dropped. So 4,200 minus 2,700. It gives you 1,500. So 1,500 is actually the gain, because the reduction in the liability is the gain. So it will be 1,500 over here. Now I hope so that all the adjustments have been mentioned over here. Now we can just total it out. That will be 29,300. Okay, now hopefully we are done with the working. Now we'll be putting that in the statement of financial position. Okay, now we'll be putting the figures in the consolidated statement of financial position, but there is one more thing here. We have taken the profit from associate of 6,000. We were multiplied by 6 by 12, but we forgot to multiply it by the parent percentage, which was 0.440%. So this was 1,200, and we need to put here 1,200 instead of 3,000. It gives you 27,500. Now let's come back to the property, plant, and equipment. Okay, we have to go to the balance sheet. Okay, the balance sheet, the balance is 37,500 plus 24,500, and plus 2,000 and minus 100. This gives you 63,900. The goodwill in the working number 2 was 12,200. We need to eliminate the investment. Okay, if you see investment, the investment was 45,000. So in this 45,000, we have 28,800 in terms of share exchange, 4,200 in terms of contingent consideration, which was recorded, and 12,000 in terms of associate. So that means there is no investment other than the group. Investment in associate, we have already calculated that thing, which gives you 13,200. So it gives you 13,200, which will be recorded over here. Okay, then you have the inventory. It's 10,000 plus 9,200. I hope so. Yes. No, it's 9,000. 10,000 and 9,000. Okay. Okay, yes. 10,000 and 9,000. Then you need to add the group in transit. Okay, what was that? The group in transit, let's see that. It was 1,800. And you need to deduct the unrealized profit, which was 600. It gives you 20,200. Then you have the trade receivables. Okay, trade receivables, let's go back. Yes, 6,500 plus 1,500 and minus intra-group, which is 3,400. Let me confirm that as well. Yes, it was 3,400. Fine. Okay, then you have the equity shares of the parent only. We can take directly because the this share exchange has been already recorded. So 25,000 plus 19,800. Okay, then you have retained earning from working number 5, which was 27,500. Okay, this one. And then you have the non-controlling interest, which was 8,400. Then you have the loan. Okay, let's go back. Yes, 14,500 plus 2,000. 14,500 plus 2,000. Okay, then you have trade payables. Trade payables is actually, okay, we have the other current liability. So we take 8,300 plus 7,500 plus the goods in transit payable, which was 1,800 minus intragroup payable, which was 3,400. Okay, the contingent consideration is 2,700 because it has been reduced. And now we can first of all total. I hope we have incorporated each and everything. So this is your total assets 114, and this should be equal to the total equity and liabilities. I hope so. Yes, good, done. So this was the question, Picant.